Everyone is saying that these 2 or 3 sectors are expected to do really well. Let's invest in sectoral mutual funds. One of my friends told me that he invested in a particular sector mutual fund scheme and he made 70% returns in last 1 year. And he's also claiming that even in the next 1 or 2 years, this sector is going to do very well and therefore the scheme is also going to perform. Are you also one of them who is investing in sectoral mutual fund schemes, or are you planning to do so very soon? If that is the case, then this video is for you. Let's brainstorm the concept and the problems of sectoral mutual fund schemes. Hi investors, welcome to today's video. Let's first understand what is a sectoral mutual fund. Let's say you are investing in a particular mutual fund scheme in which 80% or more of the amount is going to a particular sector. That's called a sectoral mutual fund scheme. Now this is as per the SEBI mandate that minimum 80% of the amount of the total size of the scheme should go in that particular sector's stocks only. For example, let's say it's a pharma sector mutual fund scheme, then 80% of the amount will go in pharmaceutical companies only. Remaining 20% can either go in other sectors or the fund manager can choose to invest in the same pharma sector, right? So basically, you are betting on that particular sector. You believe that this industry or this sector will do very well in the near future or in the long term, and you want to ride that growth. You want to make those returns because that sector is expected to do well. Now, in my opinion, investors should stay away from sectoral mutual fund schemes. Let's talk about a few things around it to understand why am I saying so. The first question which all of you should ask yourself before investing in a sectoral mutual fund scheme is, do you know this sector well? Are you an expert in this particular sector? Right? Maybe you are, let's say, working in a pharma industry, or maybe an auto industry, or maybe tech industry, IT industry, and you say, I'm in this industry for last 10, 15, 20 years, and I know this sector very well. I know the competition, I know the challenges, I know the growth potential, I know the margins, I know how the business is operated, right? So I understand this business very well. I understand this sector very well, right? And I am confident that this sector is about to do well in the next few years to come, right? Now, if this is your answer for any particular sector, my counter question will be, if you are so confident and you have the required knowledge about that sector, why don't you go and invest in 1 or 2 stocks of that sector, which I believe you would know about, and you can make much more money rather than investing in a particular mutual fund scheme which is investing in 15, 20, 25 plus stocks in that particular sector. You go to any particular mutual fund scheme which is a sectoral specific scheme, they're not investing in 5, 6 or 7 or 10 stocks. They're investing in 15, 20, 25 plus stocks, right? Now the problem here is, no matter how good the sector is supposed to do or expected to do, not all the companies or majority of the companies in that will perform. There will be companies which will make loss because of competition, right? They might go out of business rather. There will be companies which will do very well. Yeah, and there will be some companies which will do average. So when you're investing in a set of so many stocks in a particular industry, your advantage which you are going to take, which you are expecting to take, might not be as great as possible. Yeah. So if you really know the sector so well, why don't you go out and invest in those couple of stocks, or maybe 3 or 4 stocks which you know it will do well, because you are in that industry and you are saying you know this industry very well, right? Now, some of you might say, I really don't know any particular sector very well. My response to that will be, that's a good news. You're not supposed to know that. See, the reason you're investing in mutual funds is you're delegating the research work to a fund manager. If you are supposed to be good at stock selection or business understanding, then why would you go to a fund manager? You will do your own research and invest in direct stocks, right? And rather make maybe more money than what you will make in a mutual fund scheme, right? The purpose of going to a mutual fund is that you're delegating your research work to someone else and they are charging you something on that behalf, expense ratio, that what we call it, and it's a win-win situation. You make your money and they make their money, right? Now let's take a situation. Let's say a fund manager is managing a auto sector scheme, right? And majority of the stocks, 80% or more than 80% of the money of that scheme is going into automobile stocks. Now, the research of the fund manager says at some point in time, let's say in future, he or she believes, the fund manager believes that this sector might not do as well in the next few years as it has done in the past. What do you think they will do? Will they come out in the public and say that we do not believe this sector will do well, so we are closing the scheme? Chances are rare, right? They are in the business of selling mutual funds. Why will they go out and say that, you know, we are stopping the scheme, stop giving us business, and we are giving your money back, and go and take your profits, and we are done? It's hard. It's extremely rare. I mean, I've really not come up with such a scenario, right? Let's take another scenario. There is a scheme, let's say mid cap scheme or a small cap scheme or maybe a large cap scheme, which has got 60 to 70 stocks across various sectors, 15, 20 sectors maybe. Now, again, the fund manager feels or believes, as per their research, that a particular sector, again, let's say auto sector, is not expected to do well in the next few years. And they have got 3 stocks in that particular scheme, which is in the automobile sector. What do you think they will do now? Very simple. They'll sell those 3 stocks and buy something else with that money, right? Simple. That's what the fund manager is supposed to do, to research and buy and sell based on the research, so that the investors can get as much returns as possible, right? So you saw the difference in the 2 cases. Number 1, the fund manager is bound to invest in auto sector stocks because that scheme is meant to do that. In the other case, there is a flexibility to the fund manager that he or she can choose to exit a few stocks from a few industries and enter into something else as per their research. So when you are binding the fund manager, you are doing harm to yourself, not really to them. Make sure you watch this complete video and then take the quiz which is given in the description box below. Click on the link, answer the questions which are based on what you learn in this video, and you can be that one lucky winner who will get a book delivered to his or her doorstep. Please note that this link is there in this comment box only for a limited time. So make sure you take that quiz, and all the best for the book. Let's get back to the video. Another point. I also believe that just because a sector is expected to do well does not necessarily mean that a stock or a set of stocks in that sector will do well. In fact, recently I did a video on exactly this topic, that asking this question that which sector will do well is actually a bad question. I'm sharing the link to that video in the description box. Please do check that after watching this video. Now, let's take an example. Sanitizers. How many of you were using sanitizers regularly before 2020, 2019, 18, 17? How frequently and how much were you using sanitizers? Hardly. I mean, unless and until you are, let's say, in a medical industry, right? Now, this particular industry called sanitizers, or this product, has grown leaps and bounds in last couple of years. I believe we don't even have that, we can't even say what percentage it is. It might be in like lakhs of percentage, right? How much sanitizers are getting sold is like insane, right? In last couple of years, the sales has been skyrocketing, right? Tell me one company in the world which became a $1 billion company just because the sector was doing well and they were selling sanitizers. The answer is none. Not a single company across the world became a $1 billion company because the sector was doing so well and they were selling a product in that sector. Why? The reason is very simple: competition. It is the competition which killed margins of each other. I mean, I've heard people making sanitizers in their homes and selling it. Every other company which never made sanitizers, they started making that because they know there is a demand. So when a sector is supposed to do well, a lot of players jump into it and they eat each other's margins. So as a consumer, I would be happy because I'm getting many options and at competitive price. But as an investor, I might not be happy because the company in which I'm planning to invest is not really making those kind of margins or even profits which can give it that kind of growth which I was expecting. Right? So just because a sector is expected to do well does not necessarily mean that there has to be a few stocks in that sector which will do well. and that defeats the purpose of investing in a particular sectoral mutual fund scheme. Now, another point people might say is, a lot of experts are suggesting that this particular sector will do well, and they have done this in the past as well. They have predicted or projected a certain sector, and it actually did well. Right? So my counter to that is, number one, there are multiple experts in the market. First of all, whom would you listen to? Number one question. Number two, let's say you are clear that you want to listen to these 1 or 2 or 3 experts and their track record is good, right? Tell me, how many times, have you really checked how many times they were right and how many times they were wrong? Were you really following every statement of theirs? Because at any point in time, across ages, across decades, some or the other expert has been predicting about some or the other sector, that this sector will do well, right? How many people have been able to follow what they say and follow again, keep on following them to wait when they ask you to get out of that sector? Have you really been able to follow them and make your money? Because if that was possible, everyone would have done that, right? There would be no poverty in India. Just listen to a few experts. They tell you which sector to invest into, and you will make your money, right? They'll tell you when to exit. You will exit again. You will enter some other sector as per their suggestion, and they will keep on making your money, right? Last point within this, if you say no, that I really have conviction in that particular expert, please understand and ask yourself this one last question. When the last time they predicted some sector, what portion of your total investments in mutual funds, let's say, you invested in that particular sectoral mutual fund scheme? Because that will show the kind of conviction you really have in that expert. Let's say you have a total investment of 10 lakh rupees in mutual funds, and someone suggested, let's say, pharma sector or tech sector. Out of those 10 lakhs, how much money did you actually ended up investing in that particular sector? If it is like 50,000 rupees, 20,000 rupees, 10,000 rupees, 1 lakh rupees, that's like 5, 10, 20, hardly maybe 20% up to 2 lakhs, right? So if you're not investing good enough amount of your total portfolio in a particular thing in which you claim that you have conviction, even if that scheme does well, it will not make a huge difference to your portfolio, right? So how much you're investing as a portion of your total portfolio will determine the actual conviction you have in that expert, whom you claim that you really follow that person and you believe in that person. One more thing I have noticed in sectoral mutual funds is that it's like a sharp movement up and a sharp movement down. So when it is going up, the way a few sectors have done well in the last couple of years, it feels very good, and you are like in a honeymoon period, in a very good ride, and you are like, this is doing so well and I've made so much money, right? Everyone is happy in that period. But when it starts going down, it will come down in the same sharp manner, and you will not even get time to figure that out what happened, and you will keep on waiting for maybe the scheme to again go up, NAV to again go up, and it might just not happen. So the way you made those profits, it might get wiped out also at the same speed, and you will not be able to take that call to analyze and think that what action you should take, right? And one last thing in this, imagine this, that right now it is difficult for you to exit that sectoral mutual fund scheme because it has given you very good returns. My question to you is, if it is difficult for you to exit right now just because the past returns have been good, how difficult it will be for you to exit when the NAV goes down, when the performance goes down? I'm saying from the context that, let's say you are clear that you should not invest in sectoral mutual funds as a concept, as a logic, you are clear that you should not invest, but you don't feel like exiting a scheme. Why? Because it has given returns in the past. In that scenario, if it is tough to exit right now when the returns are good, how tough it will be when the scheme, let's say, goes down a little and the NAV goes down and your profits are wiped out to a certain extent. Do you think it will be easy for you to exit at that point in time? Right? So don't just look at the past returns, look at the logic, look at what is sustainable, what is more rational, what will give you sustainable growth in the long term, and invest in that case. Don't just chase returns, don't just chase sectors, rather invest in a scheme which is like a diversified equity scheme, for example, a pure mid cap, pure small cap, or a pure large cap, or maybe an index fund, so that the fund manager has got the flexibility to serve you in a way they can choose the industries at their will, depending on what they believe the future of those sectors is. Yeah, I hope this made sense to you, and this will help you take a relevant call or appropriate call in your mutual funds portfolio. In the next video, I'm going to talk about fund of funds and two big reasons why you should avoid this category of mutual fund schemes. So till that time, thank you so much. I hope you like this video. Please do like, share and subscribe, and do write your comments and let us know what more you want us to talk about. Thank you so much. See you next time.